We have reached a critical juncture in the global economy. The one asset that has soared on the wings of financial panic and geopolitical mistrust, gold, just flashed its biggest sell-off signal in over a decade. Gold's dramatic fall of about 6.3% on Tuesday wasn't a random glitch. It was a brutal stress test for the entire global financial system, asking one profound question. Is the US dollar truly back, or is this just a momentary illusion? The context is crucial. For months, the yellow metal had defied gravity, climbing to an all-time peak of approximately $4,400 per ounce on Friday. This relentless ascent, which delivered nearly 60% returns this year, was a direct indictment of the world's current financial path, a massive debasement trade fueled by boundless government deficits, endless money printing, and a terrifying array of geopolitical hotspots. Gold was the universal escape hatch from fiat currency risk. Then, the floor gave way. In a single 24-hour period, gold shed approximately $318, tumbling to nearly $4,082 per ounce. What forces could overwhelm the powerful structural demand for the ultimate safe haven asset? The market points to a triple threat convergence. First, the most immediate trigger was pure technical profit-taking. When an asset rallies by 60% in less than a year, the incentive for institutional investors to secure those profits is overwhelming. The record price was the signal for a torrent of selling, which was visible in the heavy outflows from gold-backed exchange-traded funds, or ETFs. This selling pressure alone was enough to create the sharpest single-day decline since 2013. Second, the US dollar staged an unexpected comeback, climbing about 0.4% this week. This is a fundamental headwind for gold. Since the metal is priced in US dollars, a rising dollar makes gold proportionally more expensive for buyers using other currencies like the yen or euro, immediately stifling global demand and pushing prices down. The strengthening of the dollar served as a temporary vote of confidence in United States monetary stability, shifting the technical dynamic for commodities. Third, the geopolitical fear premium momentarily evaporated. Gold is the world's preferred hedge against crises, from trade wars to global conflicts. Reports of easing geopolitical tensions, specifically improving trade relations, and the highly anticipated meeting between President Trump and President Xi Jinping injected a sudden shot of market optimism. When the world feels less on edge, investors pull capital from defensive positions like gold and rotate into riskier high-growth assets like stocks. This shift in sentiment was the final blow to gold's recent upward momentum. The reaction in silver was even more violent. The metal plunged by nearly 7.5% to around $47 per ounce. Silver is intrinsically more volatile than gold, acting as a leveraged play on both monetary uncertainty and industrial demand. While it suffered the same fate from profit-taking and a stronger dollar, silver has a powerful and unique long-term structural floor. Its essential role in the global green energy transition, specifically in manufacturing solar panels, electric vehicles, and artificial intelligence hardware, means a significant portion of its demand is non-negotiable and tied to the massive, multi-decade shift toward a sustainable economy. Therefore, while the short-term drop is severe, the long-term outlook for silver is arguably more resilient than that of its yellow counterpart. Despite the magnitude of the fall, there is a key context that everyday investors must grasp. In simple terms, while the drop was dramatic, gold is merely trading at the level it reached less than 2 weeks ago. This perspective changes the narrative from market collapse to market correction. The larger, more menacing question remains: is this necessary cooling off, or is it the first shot of a deeper secular decline? The larger, more menacing question remains: is this necessary cooling off, or is it the first shot of a deeper secular decline? To answer that, we must call on the ghosts of gold's past, specifically the disastrous crashes that followed the price peaks of 1980 and 2011. In both of those periods, the backdrop was eerily similar to today: profound economic uncertainty, high inflation, and massive government deficit spending fueling the debasement trade, the structural bet against the US dollar. In 1980, after hitting its inflation-adjusted record, gold plummeted by over 57% in a brutal multi-year decline. After the peak in 2011, driven by the fallout from the Great Financial Crisis and central banks pioneering quantitative easing, gold collapsed by nearly 45%. The fundamental reason for both collapses was the return of global confidence, largely engineered by decisive action from the Federal Reserve. When the Fed signals that the chaos is over, the flight to safety reverses, and money aggressively rotates back into equities and other risk assets. This historical warning is precisely what makes the upcoming U.S. inflation data, due this Friday, so critical for gold's immediate future. The Federal Reserve's next interest rate decision is the single most powerful factor that influences the price of gold. Why? Because gold is a non-yielding asset. It pays no interest. When the Federal Reserve raises interest rates, it increases the opportunity cost of holding gold versus holding a high-yielding treasury bond or even a high-yield savings account. The paper promises suddenly look much more attractive than the shiny metal. Conversely, when the Fed cuts rates, it lowers the return on those competing financial assets, boosting gold's appeal. Currently, markets are pricing in a high probability of a modest rate cut of 0.25% at the Federal Reserve's upcoming meeting. If the inflation data comes in tame, the Fed is likely to proceed with that cut. Lower rates would generally weaken the U.S. dollar and reduce the return on bonds, potentially providing the catalyst needed to stop gold's slide and push it back toward $4,200 per ounce. However, if the inflation data surprises to the upside, the narrative immediately shifts. It would force the Federal Reserve to pause or even reconsider its easing path. This would be interpreted as a hawkish signal, strengthening the U.S. dollar and increasing the appeal of Treasury yields, the exact scenario that triggered the deeper declines after the 1980 and 2011 peaks. For the everyday investor, this means your portfolio's fate is currently tied to a sophisticated game of chicken between Washington, D.C. and the global forces of debt and geopolitical fragmentation. The long-term outlook, however, remains anchored in the structural debasement trade. The primary support for gold is not speculative day trading. It is the unprecedented multi-year buying spree by central banks like those in China and Poland, which are systematically diversifying their national reserves away from the U.S. dollar and into gold. Central bank buying is a non-negotiable hedge against the sanctions risk and fiat currency devaluation plaguing the 21st century economy. This long-term institutional demand provides a powerful floor for the price of gold that was absent during the collapses of the 1980s and early 2010s. For now, the precious yellow metal is holding steady, trading around 1% down today as the initial shock wears off. The market has taken a necessary breather after a spectacular run. What happens next depends entirely on whether the geopolitical thaw and the dollar strength prove to be durable macroeconomic forces or merely a temporary headfake on the road to further devaluation and uncertainty. The verdict on the ultimate safety of gold will be delivered this Friday, and investors are holding their breath.